Time for another stock review. This time we're talking about NextEra Energy, ticker symbol NEP, not to be confused with NEE, NextEra Energy. We'll talk about the differences in a minute, but in this review, you're going to get a look at the profitability score, solvency score. This is the most real, unbiased review. No one pays me to do these. I'm doing them completely for free. No one pays me to influence me whatsoever. It's a service I provide to my members on my YouTube channel. We use the most advanced algorithmic software. I'm going to show you the short interest, how many people are buying on the inside, who are selling on the inside, the balance sheet, how much money they've got, the cash, latest news around the stock, sentiment. I'm also going to cover having a look at the website, and we'll discuss the differences between this and NextEra Energy as in NEE, a full back test of the stock, and also looking at the dividend. It's a dividend paying stock as well. So a lot to cover on this video. So if you like this kind of content and you want this video to be seen by more people, perhaps you like the stock and want to share it around, please do tap the like button. You'll be shown more of my content. If you don't like it, please click the down like button. I really don't mind. I just want to get the most engaged audience. That way you'll find the content that you do want. If you click the down like button, you won't see me anymore. Thank you very much indeed. Now we've got that out of the way, let's get straight into the review. Now we are going to start simple and basic, but we will get into some deep numbers as we go down the review. But first of all then, what is NEP? Not to be confused with NEE. Both, of course, NextEra Energy. Okay, let's have a look first of all at the line chart. You can see we've had some growth here in 2015, sell-off, and then all the way up, steadily going up all the way through until November 22, and then we've been crashing all the way back down again. Why is that? Well, the first thing we want to do if we're interested in buying this stock is look at the news here on the investor pages around this date and see what happened to discover what influenced the stock, and thereby what might stimulate it to go back up again. Anyway, let's go and look at more details. NextEra Energy Partners LP engages in the acquisition, management, and ownership of contracted clean energy projects with long-term cash flows. It owns interest in wind and solar projects in North America and natural gas infrastructure assets in Texas, just down the road from me. The company was founded on March 6, 2014, and is headquartered in Juno Beach, Florida, same place as, of course, NEE, NextEra Energy itself. The listed name is NEP. It's NextEra Energy Partners. Okay, so very important to know. Founded in 2014, as I said, in Juno Beach, Florida. It doesn't have any employees, apparently. I'm not sure quite what that means, but maybe this company is in relation to NextEra Energy and doesn't employ anybody directly. I don't know. I honestly wouldn't know the answer to that. John W. Ketchum. John, if you're listening, or anybody from your company and you'd like to reply to my review, please reach out to me. I'm sure people will if they enjoy this video, will email you, and investor relations. I do a Meet the CEO series. Would love to hear from you and just have you on the show, discuss your company and share your story with the world. Okay, now then, if we were buying this on margin, it's 25% maintenance. In other words, it's regarded as low risk from the point of view of using margin to buy it. The lowest is 25. Thank you, Simon, for subscribing to my channel. I'm making this while I'm live. Maintenance requirement 25%, so it's regarded as low risk. Okay, now then, 1.85 million, very low volume stock. This very, very low indeed, which means no one's really buying it or selling it really at great numbers, which means if the stock drops and no one's buying, you can't sell, the stock could go down. We've seen a big drop recently. The volume recently was about average, and not a lot more to say about that. The dividend, now then, it's important to note that this is a dividend paying stock and a very high dividend. So if you are buying the stock for a dividend, ideally you want to be buying it in your Roth IRA, because if you're buying it in your brokerage account and you earn passive income, you pay tax on it because you're receiving income. However, if it's in your Roth IRA, it's tax-free income. You could live on it, all right, if you've got enough, I guess. 11.14%. However, if the stock's going down by more than what you're getting on the dividend, is it actually viable? And how often does it pay the dividend? Well, we're going to look at that in a minute, see how often it pays it out. Does it increase it? Is it a dividend king? Is it Coca-Cola, J&J? They are dividend kings. We'll look at that in a minute and we'll see. But again, if it's coming down by more than you're gaining on a dividend, is there any point to it? We'll find out in a minute. Price to earnings ratio, 13.88. Okay. Doesn't sound a great deal. However, we need to compare that to the competition, and I'll provide you with the competition in a little while, and you can go and compare it, okay? Market cap, 5.91 billion. High today, 31.77. 52-week high, 73.42. 52-week low, 2017. And the low today was $30.10. Okay, now then. Who are we in bed with? Let's have a look. Who is buying the stock along with us? Before I give you that information, I'm going to give you the ratings of Morningstar. Now, Morningstar, remember, are paid, and they, in my opinion, have influence one way or another to rate a stock. It's not how I would buy or sell a stock, but because of what somebody has been paid to, say. I don't believe any of that stuff. They're saying buy. And a hold is 53% is the overwhelming majority here. A buy at 53%. Okay, but we'll come on to the value of the stock in a moment, so bear with me. As we can see, the stock was up in 2022, making money, and we still are making money. In fact, we're not now on the most recent range. We're actually down. Yes, we're losing money now over the most recent range on this. Anyway, we've been going steadily down, sideways down a little bit. Not a lot of positive news there to share with you when it comes to the earnings. So as we can see, we've just reported, estimated was to make 16 cents per share, and we lost 35 cents a share. There you go. That's why it is negative on the price to earnings. Oh, sorry, I beg your pardon. The price to earnings ratio is saying 13.88. I think that is a little out of date because we are losing money on the stock by the looks of things. Anyway, we'll get more into the detail of the value of the stock in a moment. And this is only very basic information so far. We're going to get much more in depth in a few moments. Anyway, who else is buying this stock? NextEra Energy obviously makes sense. I like NextEra Energy. Realty income. So we're looking at old money now. We're looking at people who like a passive long-term investment, which could mean why the stock isn't very volatile. Because, when I say very volatile, not high volume. People just kind of hold it long term. Anyway, we'll come on to that in a moment. Verizon, Medical Property Trust. I don't know about any of these last three. I do know about Realty Income and NextEra Energy. I've not reviewed any of these, but these first two I have reviewed, and I like NextEra Energy. I like Realty Income, but I think there are better opportunities in the market. But anyway, you can decide. Let me now look at the website before we go on to numbers, and then we've got the back test and other things to do as well. So let's get straight there. We've got the dividend here. We're going to go through that, the back test, and the latest information on the website. NextEra Energy Partners is a growth-orientated limited partnership formed by NextEra Energy. NextEra Energy Partners acquires, manages, and owns contracted clean energy projects with stable, long-term cash flows. So that would explain really why the company doesn't actually employ anybody. The people that work there work for NEE, and NEP doesn't employ anybody, if that makes sense. It's a It's a subsidiary, a partner of NextEra Energy, as in NEE. It manages and owns contracted clean energy projects with stable long-term cash flows, headquartered in Florida, blah, 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 blah. Okay, we've all seen the NEE. We know what NEE does, so I'm not going to go over that on this review. I've done that before on NEE. So we all know what NEE is about. It's one of the leaders in the world when it comes to solar and wind, certainly in the United States. It's a great company. I like it. I've bought this one before. I'm not now in any stocks. I only own the S&P. That way, I can't be judged for being biased, or I'm completely impartial. Now I do these reviews. I don't own any stocks at all. Okay, let me now go to the numbers. Let's look at the numbers and see how this all pans out. Okay, so let's start off first of all with the intrinsic value. Now, on its own, it's not enough, but we'll start with it. The base case, undervaluation, 71%. Best case, 81%. And worst case is 57%. Are there any warnings? No, they're not. So that's good. So far, it's good. It's a good way to get into NextEra Energy. And there's no doubt about it, in the next year, NextEra Energy is going to, that's NEE, is going to do much, much better. We've had a tough time recently. Solar's had a tough time. And I'm sure we're going to do much, much better in the coming year. So this stock is bound to do well, I would say, in the years to come. We are undervalued when we look at it here. It's saying it's worth $70, worst case scenario, and we're currently at 30. So as you can see, the stock does look like it is undervalued, but there's more to it than this. Let's move on and let's have a look. All right, now then, on the most recent earnings, NextEra Energy reported a robust full year with FPL's regulatory ROE at approximately 11.8% and capital investments totaling $9.4 billion, aiding in commissioning around 1,200 megawatts of solar and a successful hydrogen project. This is very, very big right now. Retail sales went up 0.6%, and the energy resources sector saw earnings growth about 12.9%, with over 20 gigawatts in their renewables backlog. They ensure shareholder value into 2026 and beyond. Operationally, they achieved growth in cash flow, surpassing adjusted earnings expectations. They maintain dividend growth targets at approximately 10% per annum through 2024, and LP distribution growth of 6% through at least 2026. That's very, very good. Anticipated distributions for Q4 24 are 3.73 per unit, with adjusted EBITDA targeted at 1.9 to 2.1 billion and cash distributions between 730 and 820 million. Okay, let's look at the balance sheet, the financials. The revenue is slowly increasing. We have had a dip recently, but solar has had a bit of a beat up recently. December 30th, 2023, 1.1 billion, as you can see. It's dropped off, but we are now expecting a bit of a, I wouldn't say an S-curve, a bit of an incline, and then it flattens out. But we're certainly expected to increase on the next report. Operating income, we can see this is not good at all. We actually spent 28 million negative for a time. We've been actually doing much better than this. But again, that is an S-curve. It's a nice steep operating income over the next range. So March 2024, we're expecting a nice incline. That could be very nice indeed. What about the net income? Net income is up 64% over the most recent range. Okay. Cash flow is up 27% over the most recent range. 13% less capital expenditures. That is good. Operating cash flow up 2% over the most recent range. Okay, that's okay. What about assets? We don't want to see too much long-term debt or more liabilities than assets. Do we hold any cash out of our 22.5 billion? Well, we hold 274 million. So that's pretty good, but not much out of 22.5 billion though. It's a bit of cash, fair enough, but nothing compared to our overall assets. So let's look at the long-term debt. Do we have any long-term debt? 4.9 billion. So our long-term debt, actually, if we look at it, is 26%. 26% is our long-term debt. So the debt is certainly manageable, but we're not in a position at all by any stretch to be able to pay our debts off should we wish to do so. We've only got 274 million to do that. So we can't pay our debts off, but we do have cash, and the debt is certainly manageable. And with rates coming down, which are expected by the summer, that would be a catalyst for the stock. Now then, this is not so good. Operating cash flow is fallen off a cliff. We've been making margins, but now we're not. Obviously, we're spending money, and the company's now not making any money. Net margin is actually up 19%. PCF margin is down 50%. Our ROOC is flat, ROIC is flat, ROA is 1% up, and ROE is up 6%. Okay, let's have a look at the profitability score, 48%. So it's not a bad profitability score at all. Positive net income, ROE is increasing, positive revenue growth forecast is average, but negative operating income is not so good. Not so good at all. And that's giving us a profitability score of 48. So pretty good on the profitability score. Solvency score, however, like I could tell, they do have some debt and they don't have enough cash to pay it off. So solvency score, and with what they're currently earning, we're only going to get a 35% solvency score. So this company are in sort of some sticky water right now. That's probably why the stock price is so far down. It's not going to go bust tomorrow or any time over the next year or so, but we're certainly not green, but we're not red either. So we're not in the 20s. We're not bright red, and even a bright red company doesn't mean it's going to go bust. But we're not in the best solvency position, but we're not going to go. I don't think this company is going to go bust anytime soon. And we've got a good run before that happens. And if rates come down, which they expect to, that debt they have is going to be dramatically reduced. And solar has a great year ahead of it. So with the upswing of the business and the downswing of the cost of borrowing, I would expect this to move up to the sort of the 45s, 50 within this year. So that will be good. All right, Wall Street targets. They give it an upside of 8%. So is it worth the risk? But don't forget, you've got the dividend, and we're going to come on to that in a moment. The upside of the stock price is only 8%, but if the dividend is good, then it outweighs it. We'll look at that in a moment. But otherwise, if it wasn't a dividend, why would you risk it? You buy the S&P for 15%. Or 12.5%. Why would you risk it? On the upside, on the best forecast though, 73% on the upside. Worst case scenario, 48% down. So it's hard to sort of judge which way we're going to go. A lot of macro conditions at the moment. Here are the competitors. I will give you the link for this in a moment, and you can go and compare the competition, decide which one, if their competition has a better balance sheet, and so on and so forth. Let's look at some inside trading now. Who's buying on the inside? Well, during the last 12 months, they've not sold any shares, and they have actually bought some shares. They've actually bought shares April 27th, 2023. So, quite a while ago. That was Kind Peter H., who bought $99,000 worth of shares back, back in where was it? In April 27th. So quite a while ago. But the good news is, though, there's been no buying in, there's been no selling of shares. I like to sort of think, I like to find a stock where I'm buying just before someone buys in. That way you're going to get a better deal anyway. So that's quite good. Shareholder return, let's move on down. What about short interest? Well, short interest, we have 3% short interest at the moment. There's a bit of short interest on the stock, but not much. So it's not down really because of short interest. There is some, but anything over 20 is excessive. So 3 is there's some, but to give you an idea, Apple might have 0.7 short interest. So, there's not much short interest here, a little bit of negativity, but not that much. There's no real news that I want to show you because this is all 7 months ago, out of date. My review will appear here soon because it will rank up here. But there you go. Let's go to the sentiment before we go on to a back test and the most important dividend history as well. So over the last 90 days, we have positive news 50%, 25% negative though. 30 days, negative has increased by 26%. 7 days, it's gone back to 25%. And today we have no news at the making of this video. All right, now let's look at the dividend history, because if you're buying this stock, you're buying it for the dividend history. So let's go and look at that now. Here we go. So we'll go all the way back until 2014, first of all, and then we'll move up. And you can see here, what we're looking for is consistently paying and consistently increasing. That makes it a dividend king. That can justify the loss in stock price, okay? So back in 2014, 18 cents, 19, 20, 23, 27, 30, 31, 33, 34, 35, 36, 38, 39, 40, 42, 43, 45, 46, 48, 50, 2019, 51, 53, 55, 57, 59, 61, 63, we've not missed 66, 68, 70, 73, 76 in 2022 now. So we are so far heading towards that crown of dividend king. Remember, you have to do this for a long period of time, but nevertheless, 78, 81, 84, 85, 86, they've not missed a payment and it's increased. We're now into May 23, August 23, and the most recent range was November 23 and February the 5th. So this is happening as I make this video tomorrow. I'm making this on February the 4th. 88, which is great. That's the highest so far, consistently paying it. So this is very, very good. The dividend is increasing. We talked about it in the earnings where they said they're going to go up by 10% a year. Well, that's great. 10% a year. And it's consistent all the way from, 2024 all the way back to, I say all the way back, Coca-Cola and stuff like that has been going back a long, long time. But 2014, but it's significant. It's very, very good dividend. So that in itself can justify the stock price coming down. If you're going to get a guaranteed income, if it's going to consistently go up and you can buy the stock when it's on its arse, like it is now, undervalued, this is a buy from me so far. Let's look at the back test. Okay, now then, comparing it to the S&P, the index, comparing it to the most stable asset you can own. We can only go back to 2015, but you look at 2015, if you put $10,000 in the S&P, you've got now $27,000. So nearly a 3x since 2015, which is about right. However, NextEra Energy, NEP, 10,000, you've now got 13. So you've made a profit, but you would have made a lot more with the S&P. And that is including reinvesting the dividends. But remember, the dividends are going up now 10% a year. So the dividends are improving, and the stock price is where it was around about 2015, 2016. So with what's going on now, with interest rates about to come down, with solar about to go up, the stock price now at where it started from around about 2016, and the dividend increasing, it certainly looks like a buy from me. So there you go. That is my review on NextEra Energy NEP. This looks like for me a buy. Now, if you want those links, I did say I would give you some links where you can get my software and you can check the link, you can check the competition and go deeper into the review. Click above my head or down in the description, you'll find the links. Now, I use Alpha Spread. If you use my link, you get a free plan, completely free. If, however, you choose to have a premium plan where you want as much information as I've shown you today, plus a lot more, and you want to review lots of stocks, you can get a premium plan. If you do, they pay pay me a small one-time commission. You don't pay anything extra for that. That's just a little bit that I get because you signed up. But if you do use the free plan, I don't get anything. Just so you know, there's a free plan and you can do that. So go and check it out. You might as well get the software that I'm using because it's fantastic. I use it for all my investments. I think it's the right software, as it's based upon numbers, not people's opinions, just numbers. So click above my head for that, and down below, also all my links to social media. So when I update information or I talk to the stock, the CEO, I do have a Meet the CEO series. You'll be kept up to date with all future updates on the stock as well. Okay, over here you'll see my full list. I've done many reviews on stocks, and I'm adding more all the time. If you want to add yours, comment below the video, leave me your thoughts, and if you're a member of my channel, I will do a review for you free of charge. It's just part of the service. I'm here to help people out. It's not financial advice, but this is just my opinion based upon the facts and the numbers. That's it. All right, so click above my head, down here, over here, and I'll see you on the next review. Until then, as always, take care of yourselves and each other.